Have you ever wondered why casinos never go bankrupt while gamblers always do? Picture this. Las Vegas is filled with massive palaces, glittering lights, and free entertainment, all built on one simple principle. Every single day, thousands of people walk through those doors convinced they'll beat the house. Yet somehow, the house keeps winning. The shocking truth is that trading the stock market works exactly the same way, except here's the twist: you get to choose which side of the equation you're on. You can be the gambler who eventually loses everything, or you can be the casino that profits regardless of individual outcomes. Today, I'm going to reveal how professional traders use the exact same mathematical principles that make casinos billions of dollars, and how you can be wrong on most of your trades and still make consistent money. This isn't about lucky streaks or hot tips. This is about understanding probability, managing risk, and thinking like a business owner instead of a desperate gambler. The secret that separates successful traders from those who blow up their accounts isn't some mysterious market knowledge or perfect timing. It's adopting the casino mindset. Let me break down exactly how this works and why it's so powerful. Think about what a casino actually does. They don't care whether you win or lose any individual hand of blackjack or spin of the roulette wheel. They care about the mathematical edge they've built into every single game. Take roulette as a perfect example. Most people think when they bet on red or black, they have a 50-50 chance of being right. But that's not true. Here's the genius of the casino's design. There are 18 red numbers, 18 black numbers, but also 2 green numbers, 0 and 00. So when you bet on black, your chance of winning is actually 18 out of 38 possible outcomes, which equals about 47.3%. The casino's chance of winning is 20 out of 38, or about 52.7%. That tiny 5.4% edge is what built every casino empire in history. Now here's the crucial part. The casino doesn't know or care what happens on the next spin. They might lose 10 spins in a row. They might win 15 straight. What they know with absolute certainty is that over thousands of spins, that 5.4% edge will generate predictable profits. If people bet $1 million, the casino will make approximately $54,000. The more people play, the more money the casino makes. This is called positive expected value, and it's the foundation of every sustainable business model. The casino operates with complete emotional detachment from individual results. They've done the math, they trust the process, and they let probability work in their favor over time. This is exactly the mindset that separates profitable traders from everyone else. Now let's look at why most traders fail spectacularly. They approach trading like gamblers instead of casino operators. When the average person buys a stock, what's their chance of being right? Essentially 50-50, it either goes up or down. But here's where it gets worse. Because of emotional decision-making, most traders actually lose more when they're wrong and make less when they're right. Here's the typical pattern. Someone buys a stock at $10, convinced it's going higher. The stock drops to $9. Instead of cutting their loss, they think it'll come back tomorrow. It drops to $8. They hold on, hoping it'll recover. By the time they finally sell, they're down 30 or 40%. But when that same stock goes from $10 to $11, fear kicks in. They think about all their previous losses and sell immediately to lock in that small profit. This creates a devastating pattern: small wins and large losses. Even if you're right 50% of the time, this approach guarantees long-term failure. The emotional responses of hope and fear cause traders to do exactly the opposite of what they should do. They hold losers too long and cut winners too short. Professional traders flip this equation completely. We don't trade based on hope, fear, or opinions. We study repeatable patterns in price movements and only enter trades when the statistical probability is in our favor. This is called technical analysis, and it's how we create our edge. Let me give you a concrete example. When a stock is in an uptrend, it doesn't move in a straight line. It moves in waves: up, then a small correction, then up again, then another small correction. When the price touches a support level during these corrections, there's a statistically higher probability that it will bounce back up. Not a guarantee, never a guarantee, but a probability better than 50-50. Let's say this pattern gives us a 60% win rate. Even if we're wrong 40% of the time, we still have a 20% statistical edge. That's 4 times better than the casino's edge in roulette. But here's where professional traders take it to the next level. Unlike casinos that bet 1-to-1 with players, professional traders never risk $1 to make $1. We always structure our trades to risk $1 to make at least $2, and often much more. We do this through precise risk management, placing stop losses to limit our downside and profit targets to capture our upside. Here's how this looks in practice. Say we identify a trading setup where a stock is at $11, sitting on a support level. Based on our analysis, we believe there's a 60% chance it will rise to $15. We buy at $11, but immediately place a stop loss at $9. This guarantees that if we're wrong, we'll only lose $2. If we're right and the stock hits $15, we'll make $4. So we're risking $2 to make $4 with a 60% win rate. Let's do the math on 100 trades. We'll win 60 trades and lose 40 trades. 60 wins times $4 equals $240 in profits. 40 losses times $2 equals $80 in losses. Net profit, $160 on a $100 investment. That's a 160% return. But here's the beautiful part, even if our win rate drops to just 50%, we're still profitable. 50 wins at $4 each equals $200. 50 losses at $2 each equals $100. We still make $100 profit, a 100% return. This is the power of the casino mindset. We don't need to be right most of the time. We just need positive expected value and the discipline to execute our system consistently. Every individual trade is irrelevant. What matters is the cumulative result over many trades. The psychological shift this creates is profound. When you think like a casino, losing trades don't trigger emotional reactions. They're simply the cost of doing business. You expect them, you plan for them, and you know they're necessary parts of a profitable system. A casino doesn't panic when someone wins big at a slot machine. They know it's all part of the statistical distribution that ultimately favors them. This is why successful traders keep detailed records of their trades, not just the financial results but their execution quality. Were they disciplined about their entry criteria? Did they stick to their stop loss? Did they take profits according to their plan? The actual outcome of any individual trade is less important than whether they followed their process. Risk management becomes your casino's built-in edge. Never risk more than a small percentage of your total capital on any single trade. Most professionals risk between 1 and 3% per trade. This ensures that even a string of losses won't devastate your account. Diversification across different markets or strategies provides additional protection. The casino never puts all their money on a single bet, and neither should you. They spread their risk across thousands of individual games and millions of individual bets. You should spread your risk across multiple trades, different time frames, and various market conditions. Emotional detachment is crucial for maintaining this casino operator mindset. Develop pre-trade routines that remove emotion from decision-making. Create checklists that ensure every trade meets your criteria before you enter. Set your stop loss and profit target before you even place the trade. This removes the temptation to make emotional adjustments when your position moves against you. Many successful traders actually celebrate their losses when they execute them correctly. If you bought a stock at $11 with a stop loss at $9, and the stock drops to $9 and you cut your loss immediately, that's actually a victory. You demonstrated discipline and protected your capital for the next opportunity. Keep a trading journal that tracks not just your profits and losses, but your emotional state and decision-making process. Were you anxious when you entered the trade? Did you second-guess your stop loss? Did fear or greed influence your exit? This self-awareness helps you identify and correct behavioral patterns that sabotage profitability. The casino mindset also changes how you view volatility and market uncertainty. Casinos thrive on uncertainty. If gambling had predictable outcomes, they couldn't make money. Similarly, volatility creates the opportunities that allow skilled traders to profit. Instead of fearing market swings, professional traders welcome them as chances to apply their edge. Successful traders also understand that different market conditions require different strategies, just like casinos offer different games with different house edges. What works in trending markets might not work in sideways markets. Having multiple strategies in your toolkit ensures you can adapt to changing conditions while maintaining your statistical edge. Position sizing is another critical element of the casino model. Casinos set table limits not to prevent big wins, but to manage their risk exposure. You should determine position sizes based on your account size and risk tolerance, not on how confident you feel about any particular trade. Confidence is an emotion, and emotions are the enemy of consistent profitability. The compounding effect of maintaining a statistical edge over time is extraordinary. A 20% annual return might not sound exciting compared to stories of traders making thousands of percent in a year, but it's sustainable and builds real wealth. The traders who chase huge returns usually end up losing everything, just like gamblers chasing the big score. Consistency beats brilliance in trading. The casino model proves this every day. They don't need brilliant individual decisions. They need consistent execution of a proven edge. Your goal isn't to hit home runs on every trade. Your goal is to get on base consistently and let the law of large numbers work in your favor. This approach also helps you avoid the psychological traps that destroy most traders. You won't overtrade because each trade is just one small part of a larger process. You won't revenge trade after losses because you understand that losses are built into your business model. You won't risk too much on any single trade because you know that preservation of capital is more important than any individual opportunity. The casino never closes. They're always ready for the next customer, the next bet, the next opportunity to apply their edge. As a trader with a casino mindset, you maintain the same readiness. You don't get discouraged by losses or overconfident from wins. You simply execute your system and trust the mathematics. Understanding market psychology becomes easier when you think like a casino. You recognize that other traders are driven by the same emotions that drive gamblers: hope, fear, greed, and desperation. These emotional reactions create the price inefficiencies and patterns that you can exploit with your systematic approach. The beauty of this mindset is that it removes the pressure to be right about market direction or timing. Casinos don't predict which number will come up on the roulette wheel. They profit regardless of which number comes up. Similarly, you can profit in rising markets, falling markets, and sideways markets as long as you maintain your edge and execute consistently. Building this casino operator mindset takes time and practice. You're rewiring years of conditioning that tells you each trade is a test of your intelligence or worth. Instead, you're learning to see trading as a business with quantifiable risks and rewards. Every successful business accepts losses as part of operations. Restaurants throw away unsold food, retailers mark down obsolete inventory, manufacturers deal with defective products. Your trading business should operate with the same rational acceptance of inevitable costs. The difference is that in trading, you can calculate and control those costs precisely through proper risk management. This control gives you an enormous advantage over emotional traders who let their losses run wild. The casino model also emphasizes the importance of continuous improvement. Casinos constantly analyze their operations, looking for ways to improve their edge or reduce their costs. They test new games, adjust payouts, and optimize every aspect of their business. As a trader, you should constantly review and refine your strategies, looking for ways to improve your win rate or risk-reward ratios. Technology has made the casino model more accessible to individual traders than ever before. You can backtest strategies on historical data to verify their statistical edge before risking real money. You can automate position sizing and risk management to remove emotional decision-making. You can track detailed performance metrics to ensure you're maintaining your edge over time. The transformation from gambler to casino operator doesn't happen overnight, but the results justify the effort. Instead of hoping for lucky breaks or perfect trades, you build a sustainable business based on mathematical principles. Instead of experiencing the emotional roller coaster of random wins and losses, you enjoy the steady satisfaction of watching probability work in your favor. When you truly internalize the casino mindset, trading becomes less stressful and more profitable. You stop trying to predict the unpredictable and start managing the manageable. You focus on process instead of outcomes, knowing that good process leads to good outcomes over time. The markets will always contain uncertainty and volatility. You can't eliminate these factors, but you can profit from them by thinking like a casino. Accept that individual trades are random events, but position yourself to benefit from the statistical distribution of many trades. Maintain strict risk management to ensure you can stay in the game long enough for your edge to manifest. Execute your strategy consistently, regardless of recent results or market conditions. Remember, every casino started with this simple recognition: they couldn't control individual outcomes, but they could control their edge and their risk management. By adopting the same mindset, you transform trading from gambling into a systematic business with quantifiable risks and predictable long-term returns. The choice is yours. You can continue approaching the markets like a gambler, hoping for lucky breaks and gradually bleeding money to more systematic participants. Or you can adopt the casino mindset, build a sustainable edge, and profit consistently regardless of whether any individual trade wins or loses. The mathematics are clear, the principles are proven, and the opportunity is waiting. Stop trying to be right about every trade and start being profitable over every 100 trades. That's how you truly trade like a casino.